Hey everybody, Smart Silver Stacker here. Welcome to another live stream. Today we're going to be discussing the breakout in the gold price to record all-time highs. So you're looking at the weekly chart now of gold up in the top corner of your screen. Got an article here from Investopedia about a pattern that is forming in the gold chart. Now we've touched on some of these points in the past, but given the breakout, I think it is worthwhile to review this information and this chart, see what we can extrapolate from this. We'll see how high the price of gold might be headed from here. And then also we're going to talk about when we might see the silver price joining gold in this breakout. So do me a favor, put a 1 in the chat if everything, you can see everything. This is a little bit of a different orientation than I've used for previous live streams, and then let's get right into it. So this article here from from Investopedia is called a Cup and Handle Pattern, How to Trade and Target with an Example. And there's a few points I want to touch on here. Let's zoom this gold chart out and we'll take a look because there is a cup and handle formation here very clearly. We'll go over some points and we'll see what Investopedia says about how to trade this pattern. So first of all, what is a cup and handle? Well, it's a bullish signal that extends an uptrend. And it's used to spot opportunities to go long. And these are not my words. I'm not some technical analysis wizard here. I'm just going by what is on this Investopedia article. So basic stuff here, really, but you don't have to be a TA whiz to spot this pattern. Now, let's take a look at some ways we can confirm that this is a good cup and handle formation. So scrolling down here, I've got 3 points to consider that we've got highlighted here. First is the length. So generally, cups with longer and more U-shaped bottoms provide a stronger signal. Avoid cups with a V bottom, a sharp V bottom. And as you can see, this is a very broad U-shaped bottom, nice and wide. I mean, it plays out over more than a decade, so you can pretty much check that box. Now, moving on here to depth, it says, ideally, the cup should not be overly deep. Avoid handles that are overly deep also, as handles should form in the top half of the pattern. Now, as you can see here, this is the handle where you have these parallel lines where gold has been trading for the past several years, and it is completely within the top half of the cup. So you can check that box too. And then finally, there's a note about volume here. Volume should decrease as prices decline and remain lower than average in the base of the bowl. It should then increase when the stock begins to make its move higher back up to the previous high, to test the previous high. Now, we don't have volume for gold here, but what we can look at is the chart for the GLD, which is a proxy. It's an ETF, which is a proxy for the gold price. And we actually have volume data here, and we can kind of zoom this out. What am I looking at? I'm sorry. This is not what we should be looking at here. This is something else. Let's see. GLD, that's what I want. Okay, it's showing some ratio. Well, anyway, I guess we can skip this part today because I'm not going to try to troubleshoot TradingView on a live stream. But I can tell you that if you look at the volume data for the GLD, the volume data is in line with exactly what Investopedia is describing here. So this is basically a confirmed cup and handle formation as far as I am concerned. Now, how to trade this? This is interesting because this is where we can start to examine what gold investors might want to do next, what the price target for the high might be. And, keep in mind, none of this is financial advice, but we're going to take a look at what Investopedia says about how to trade this. So they say you can place a stop buy order slightly above the upper trend line of the handle. Order execution should only occur if the price breaks the pattern's resistance. Traders may experience excess slippage and enter a false breakout using an aggressive entry. But at this point, we've got a weekly close way above this trend line. I would say that anybody who did that, I mean, the time has kind of passed for that, but that's okay because we're going to talk about another way to trade this in just a moment, but anybody who had a order, say around 2100, has done pretty well, and I think they're going to continue to do well. However, if you missed that, it says here, alternatively, wait for the price to close above the upper trend line, so check. Subsequently, place a limit order slightly below the pattern's breakout level, attempting to get an execution if the price retraces. There is a risk of missing the trade if the price continues to advance and does not pull back. Now, this is interesting because this is something that I've heard a lot of people talking about, a potential pullback in the price of gold now that we've broken out to these all-time highs. And that is a possibility here. But for one thing, it actually would be really bullish. That would be one of the most bullish things we could see right now if this line, this top of the trend line around 2100, which has been resistance for a long time. You can see we tested that 1, 2, 3 times. We had a false breakout at the end of 2023. That was in overnight trading on a Sunday. You can see we got this spike above it, but never a close. So 2100 was resistance for a long time. If we retest it and bounce off of it strongly, that will show that that resistance has now become support. And so, we might get one last buying opportunity here, as it says. However, there is a risk of missing the trade if the price continues to advance and does not pull back, which is a real possibility now too. We might not get a retest of 2100. It might just be off to the races from here for gold. But if you do see gold falling back to that line, don't think that, that's a sign that, gold is done and it's reached its top at 2178. No, it's more likely that it's going to retest that support and bounce off, and, it's going to move hugely. Now, one thing I do want to point out here is that they say a profit target is determined by measuring the distance between the bottom of the cup and the pattern's breakout level and extending the distance upward from the breakout. So zooming out, that would mean a bottom here of the trough here around 1050 to 2100, which is the top of the handle. That's about $1,050, right? So about a doubling in the price. So what you'd want to do is add 1050 to this top line of 2100. It gives you a price target of about 3150 for gold. So that is why I think that could be where we are headed in relatively short order for the price of gold. Now, there might be some volatility on the way up, but now that we've broken out of this chart, it is a good sign that we are going to run at the $3,100 level. Now, let me go ahead and pull these charts down for a second here and just get this centered, because I want to talk about that, why 3150 is a pretty reasonable price target. If we look at an inflation calculator, the actual inflation adjusted all-time high for the price of gold, if you go back to 1980, when gold was at $850, it is quite that number. If you adjust it, $850, and I'm going to have to redo this, I guess, on this inflation calculator, in today's dollars, is right at 3181. Now, you can find different calculators that might let you use January specifically when gold had its peak. That'll give you a slightly higher number. This is using CPI data though, right? 274.3% cumulative inflation rate since gold reached its previous inflation-adjusted all-time high, and that would put gold headed right towards $3,181. So that is right in line with the prediction from the cup and handle formation. Now, let's talk about silver. Is silver going to follow suit? Are we going to see an increase in the price of silver commensurate with this breakout that we have had in the price of gold? Well, one signal that might show that, I've got an exchange here from between myself and James Anderson. I know a lot of people think that silver is never going to break out because it is manipulated, and that is just going to keep a lid on the price of silver indefinitely. Well, this is interesting because he says here, if you believe ongoing unsecured SLV data, so SLV, the big ETF, about negative 270 million ounces of silver bullion have upped and gone since Q1 of 2021, silver squeeze. 11,250 of those 24 by 1,000 ounce bar pallets. So that's how much has flowed out of the SLV since the silver squeeze. You can see when the amount of silver that the SLV held peaked, it has now declined significantly. And, this is one of those things that really could trigger a spike in the price of silver, is if the manipulation, the ultimate end game for that is that there's not enough physical backing up these paper instruments. You keep the price of something like silver artificially low for too long, you're going to create a shortage, you're going to run out. And I asked James here, I said, what happens when the SLV is drained completely? And he said palladium in 2019 is a clue. Now, this is some interesting charts that he posted in response. You can see the amount of physical palladium held in these warehouses declining, and commensurately, the price moving higher. It's peaked in 2022 there at, that's the value in the warehouses. Here's the palladium price, peaked at over $3,000. So from the time that the inventories began getting drained to the time when they bottomed, the price moved up tremendously. Another clue, when you talk about this manipulation, where silver could be headed, is what happened with the nickel market, right? This is a report from Bloomberg from March 14th of 2022. The 18 minutes of trading chaos that broke the nickel market. So if you think that silver is being artificially held down via naked shorting with paper instruments, do me a favor, put a 2 in the chart if you think there's rampant manipulation. Put a 3 if you think the main thing driving this is just market forces. I'd be interested to know what you think. I think most of you are going to fall on the side of manipulation. Now, to me, we know manipulation goes on. There were the JP Morgan traders that were indicted and convicted of spoofing the gold market. And that is a sign that there is manipulation. To the extent that it's the main thing driving the silver price, I'm not sure. But if it is, we can probably expect a day like this in silver. What happened on March 8th with nickel? So it was 5:42 a.m. on March 8th in London when the nickel market broke. At that time, bleary-eyed traders are typically just glancing at prices as they swig coffee on their way to the office. On this day, however, metal traders across the city were glued to a screen watching the price action of the electronic market, which was already open to accommodate Asian trading. Nickel prices usually move $100 per ton in a day. For most of the past decade, they traded between $10,000 and USD 20,000. So for a ton of nickel, it was between $10,000 and $20,000. Yet the day before, the market had started to unravel, with prices rising by a stunning 66% to $48,000. Now the traders watched with a mixture of horror and grim fascination as the price went vertical. Already at an all-time high by 5:42 a.m., it lurched higher in stomach-churning leaps, soaring $30,000 in a matter of minutes. Just after 6 a.m., the price of nickel passed US $100,000 a ton. Now, this is what happens when you have a bunch of short positions in a physical commodity and a short squeeze occurs, right? This was Zhang Guangda was the guy's name, who was a Chinese, or is still a Chinese, nickel magnate. He had these huge short positions. Now, what happened was the London Metal Exchange froze trading in nickel. They actually shut down the market. They punished all the people who had long positions, and they bailed out their buddy who had the short positions. And, this could easily happen in silver too. But the thing is, there's a big difference between nickel and silver in that nickel is kind of difficult to take physical possession of yourself. It's very heavy. But whereas silver, this is a huge example of why you need to have physical metal in your possession as your core position, because if we see a short squeeze play out in silver when it breaks out and catches up with gold, as typically happens during precious metals bull markets, if there is a lot of manipulation going on with paper instruments, there is a situation where you're very ripe for a short squeeze, and the silver squeeze might still happen. I know it's been 3 years since the silver squeeze, and what's been happening? Physical silver has been getting drained by us, by the stackers. There's less and less of it. There's a supply deficit every year. The warehouses are draining. So, we may be headed towards a situation where the price of silver absolutely explodes. And I think that is likely coming up. Now, again, that's typically what happens. This is the chart of the gold to silver ratio, courtesy of SD Bullion, today's video sponsor, by the way. Make sure you check them out with the link down in the description. If you want to get some gold or silver, silver to me is still incredibly cheap. Gold is at record highs, but probably heading much higher. you might not want to wait for that pullback because as that Investopedia article mentioned, there's the threat of being left behind. Now, maybe you will get a pullback in gold, and if it happens, I mean, I would consider stacking some myself. I'm not telling anybody what to do. It's not financial advice, but what happens typically when the price of gold or silver, when both metals are in a bull market, you see silver outpace gold. That's why in 2011, when gold and silver were both taking out, multi-decade highs, the gold to silver ratio collapsed down to 33.51, as you can see in this chart. Today, we are close to 90. Now, in 2008, when the metals bottomed during the great financial crisis, you had a gold to silver ratio of 81-21, kind of closer to where we're at today. And then you had a huge bull market for the next 3 years, and this ratio compressed. Now, maybe, that's just a one-time example. However, there are other examples of this that you can observe on the gold to silver chart. This one from SD Bullion, it only went back to the 90s. If you go back to the 1980s, you can see that, there's a huge gold and silver bull market, not just silver. It wasn't just the Hunt brothers. Gold was also taking out all-time highs. And if you adjust for inflation, we still haven't hit the highs of 1980. But in 1973, the ratio got up as high as 44-31. Now, that's not as high as it is today, but look how far it fell, right? It fell down to about 15 in 1980. So, in the past two major gold bull markets in the fiat dollar paradigm, since the dollar was taken off of the gold market, or off of the gold standard, what you have seen is when the metals are rallying, silver has outpaced gold. Now, is that going to happen again? I don't see any reason why that would not be the case. The fundamentals are there for a huge silver price increase. And if you'll notice, it usually isn't until the very end of the bull market that silver takes off. I mean, silver tends to lag gold because, this bull market ran from 2008 to 2011. But look at, even in July of 2010, the ratio is still as high as 65. It's in the last blow off top phase of the bull market that you get the price of silver outpacing gold in a very significant way. So, when is the price of silver going to catch up? It's anybody's guess, but when it does, I mean, if you're talking about a gold price of $3,000 plus, I mean, even if we just go to the same gold to silver ratio we went in 2011 of close to 30, I mean, you're talking triple digit silver, right? Like at least a 4x increase from where we are at today. And you think of the percentage difference between gold today and the 3150 target, what is that? About a 50% increase. You're talking about a potential 400% increase in silver to arrive at the same gold to silver ratio we had in the last bull market for the precious metals. And there's any number of things that could really kick this off. I mean, it could be the COMEX getting drained of silver. It could be the SLV running out of physical silver. I mean, to me, I believe the custodian for the SLV is JP Morgan. I mean, I'm a little bit skeptical that they even have all the silver that they have. As James said, if you believe their data, this is what's happening. There were those the warehouse of nickel that JP Morgan was supposed to have, and it turned out to just be rocks. I mean, I don't have that story pulled up, but they had a warehouse full of rocks that on their balance sheet it said was metal, right? So who knows how many of those ounces of silver that the SLV has are real or not. I mean, if you're skeptical of that, put a 4 in the chat. If you think that that's, a reasonable skepticism, and it's not just tinfoil hat stuff. I mean, we know there's a lot of manipulation here. JP Morgan, of course, the ones whose traders were responsible for manipulating the price of gold and silver, they were indicted of that. Now, I've talked about manipulation recently. A lot of times I'll be skeptical of the manipulation, and I think that rubs some people in this community the wrong way. You can let me know in the chat if you are. And it's like, I'm not saying that there's not manipulation. In fact, we know 100% that there is manipulation of the gold price and of the silver price. We know that because of those indictments, but we just don't know exactly how much that really contributes to the price action in the metals. To me, it's a mixture of market forces, maybe some manipulation here. I'm not convinced that the reason gold or silver hasn't taken off yet is because of manipulation. Maybe it's the soft manipulation, the manipulation of people's opinions towards silver. I think that it's, just generally the sentiment among investors towards silver right now is still in the toilet. Like very rarely have I heard people speak so negatively about silver, especially in this community, even in comments left on this video in the, other various social media interweb platforms that I look at. When silver takes off, you're going to see a huge change in public sentiment towards this. Now, I think maybe the public is getting a little bit of a clue because the price of gold is breaking out. But again, look at premiums from places like SD Bullion, your other online dealers. Go to your local coin shop. Premiums are still very low. That's a sign that investors, retail investors, are not what's driving the price action in the metals. I mean, what's driving the price action in the price of the metals right now is central banks. It's smart money. It's millionaire and billionaire investors. We've been reading reports that Mark Zuckerberg is buying gold. I mean, look, if you've got billions of dollars, you don't need to trouble yourself with silver coins, right? I mean, you're going to go for 1 ounce gold coins at a minimum, I would expect, probably bars of gold, right? But, when the average retail investors, folks like you, folks like me, people who are just trying to, protect some of their hard-earned money from the ravages of inflation, when they get the memo that there's a lot more inflation on the way, that's when you're going to see the price of silver really take off. That's when you're going to see premiums, meaning the price of actual physical metal, really take off. And then, you do have a scenario where you're set up, to the extent that there is manipulation keeping the price low, for a massive short squeeze like what they saw in nickel, except the difference is, again, that you have the option to take your silver. And I think there's a lot of people out there, a lot of investors, could be even, banks, big money traders who've got these paper positions in the precious metals. They're probably just going to get settled in fiat currency, right? Because we know there's not enough metal to break, to make everybody whole on their positions. You see Captain here in the chat saying, will silver ever break out? And I mean, look, I don't know. You don't know what you don't know. I don't have a crystal ball. I believe that, yes, we will see a breakout in silver. We're seeing the beginning of this in gold. Now, the fact that silver hasn't really begun to move yet is an indication of just how early we are on what will likely be a multi-year bull market in the metals. And I mean, silver has been moving on some of these days with gold. It was interesting. Yesterday, we got that non-farm payroll data. Everything was selling off on that. I mean, it's the same dynamic. It was better than expected jobs numbers. And we saw markets in the red. We saw silver in the red, crude oil in the red. Gold actually was in the green. Now, that's a big sign that the breakout in gold is durable, that it's strong. I think it's a sign that we might not get that retest of 2100. But at this point, looking at the gold chart, nothing would be more bullish than getting a retest of that $2,100 line. So, I mean, if we get that, I know that there's going to be a lot of people out there who are going to say, oh, looks like it's in a bad day for gold, bad day for silver. I get those comments sometimes. Gold will be down or silver will be down, and I'll get people who come on individual videos and they say, oh, no, another bad day for silver, another bad day for silver. And to me, it's like, no, another good day for stackers, because we can load up on this stuff cheaper before it really takes off. I don't know about you. I'd be thrilled to get a drawdown in gold back to the $2,100 level, probably the last chance to buy it at that price that we are going to get. And you can bet that if the 2100 is now support, which I believe it is, that any bounce off of that is going to be astronomical, and gold really will begin its moonshot. Now, it's not going to be overnight. I mean, you got to be patient with these things. I don't know when gold is going to hit 3150. I mean, is it going to happen in 2024? Maybe. I mean, they're certainly printing enough money. They're racking up enough debt to warrant a move like that. But that might not happen. It might hit it in 2025 or 2026. But I mean, the longer it takes, the better to me, because I'm probably going to be buying on the way up too. Now, you want to know when you might want to consider exiting, right? Because I'm sure it's like everybody says, you guys are perma bulls, you're just loading up on gold. Well, for one thing, I mean, you can pass this stuff on to, future generations. It's really the only way to pass on generational wealth, if you ask me, is physical gold and silver that makes any sense. And you want to, test that, just back test it. You go back several thousand years, and if you've been passing the gold and silver down, it's still money, still good to go, at a record all-time high in terms of fiat dollars right now. But anyway, I'm kind of rambling at this point, sort of lose my train of thought there. But look, I I think that now is a huge opportunity in silver. I don't give financial advice, but I'm going to keep stacking. I've got some more junk silver on the way. And with the way things are going, I mean, we got a bank crisis burgeoning. We've got the U.S. debt going up $1 trillion every 100 days. You know, we're on the verge of war. There's huge instability. More inflation is baked into the cake. And the fact that we can still get these assets cheap is really, I think, a giant gift. You know, I think there's been a lot of distraction among investors in terms of cryptocurrency, the latest, hottest AI stocks. A lot of money that might have flowed into gold or into silver has been going to alternative targets. But again, this is a huge benefit to stackers because I don't know about you, but I like to buy stuff that's cheap. And again, I've been patiently stacking silver for about a decade, a little over a decade. And you know, I'm okay being patient moving forward because, again, the fundamentals, they all align. You look at gold, it's the fundamentals and the technical chart now. I mean, the chart looks beautiful. This is like, you know, set. We've been waiting for this breakout. I've been talking about it for, I feel like, over a year now, this pattern forming here. And the fact that we've now broken out above it, well, you know, it's here. And we're still in the very early phases of this, so we can still take advantage of it. But that's it for today, everybody. Let me know what you think about any of the topics that we covered in today's video. What do you think the catalyst could be for a breakout in the price of silver to catch up to gold? Do you think I'm wrong? Maybe we won't see the gold to silver ratio collapse. That was one thing I was going to mention was if you want to look for a time to unload some of these assets, I think the thing to keep an eye on is that gold to silver ratio, also the Dow to silver ratio, the Dow to gold ratio, the ratio of all these various assets to one another, because right now silver's super cheap. So silver's cheap relative to gold. They're both cheap relative to paper assets. It's when those ratios change that you want to start examining potential exit strategies. You know, maybe roll some of your silver into gold if the ratio drops. Maybe roll some of your gold and silver into paper assets if those sell off and become undervalued when gold and silver are moving higher. You know, when everybody else is wanting to buy gold and silver, that's probably a good time to at least lighten up your position. I'm not saying, you know, get rid of your core physical holdings, but if you're holding some more speculative stuff, some paper positions, some miners, or even just some extra gold and silver that you maybe are ready to, you know, get off your hands, that would be the time to start looking at that. But right now, I think is the accumulation phase, especially in silver, but even still in gold. So anyway, again, let me know what you think in the comments down below. Stay safe and happy stacking, everybody. I will catch you next